Hello again. This afternoon we're going to be talking about one of my favorite subjects, contrary opinion. And contrary opinion is the idea that when everyone thinks alike, the prevailing trend is likely to reverse. Most people think, well, if I know everyone's bearish, then I'm going to be bullish and I'm going to make money. But it's not quite as simple as that, as we'll get to understand as we move through the presentation. In actual fact, the crowd is usually correct as the trend is getting underway. And the crowd is long and the price goes up. That's usually the way it is. It's at the turning points that the crowd is usually wrong. So, what is contrary opinion? Well, some time ago I read in Barron's magazine what I regard as the best description of contrary opinion, or definition of contrary opinion I've ever seen, by a chap called John Schultz. And I'll read the definition to you, and then later on we'll go through parts of it, and you can see how it all fits together. He said the guiding light of investment contrarianism is not that the majority view, the conventional view, or received wisdom is always wrong. Rather, it's that the majority opinion tends to solidify into a dogma while its basic premises begin to lose their original validity and so become progressively more mispriced in the marketplace. So what are the steps to forming contrary opinion? Well, the first step is to figure out what the crowd thinks, because if you don't know what the crowd thinks, how can you be contrary? So that's the first step. The second step is to say, okay, the crowd thinks this, I've got to think of an alternative scenario that may come to pass, which the crowd has not thought about. Because it's the alternative scenario, if it comes to pass, that it's going to reverse the bear trend into a bull trend, or the bull trend into a bear trend. And the third thing is to decide when the crowd moves to that extreme, because I mentioned before, when the crowd moves to an extreme, that's the time when it's typically wrong. So those are the three steps in forming a contrary opinion. Figure out what the crowd thinks, then form an alternative scenario to the crowd, and look for things that may cause that alternative scenario to happen. And third, decide when the crowd moves to an extreme, because that's the point at which you probably want to take some action. And part of this presentation is also concerned not just with contrary opinion, but using technical analysis, which is a timing device, of course, to try and figure out when the crowd moves to an extreme and so forth. So by integrating the theory of contrary opinion with some of the principles of technical analysis, we can get our timing a lot better, because sometimes forming a contrary opinion can be agonizingly early and painfully early. So by using and integrating the technical analysis, we come out with much better timing than if we didn't have the technical analysis. So let's go back to this description or this definition that John Schultz had and see how that fits into what we just said. Well, first of all, the guiding light of investment contrarianism is not that the majority view, and here we say the conventional view, because the conventional view, going back to our 3 points, is figuring out what the crowd thinks. If we can figure out what the conventional view is, then we've reached our first step in forming a contrary opinion. Not that the conventional view or received wisdom is always wrong, rather it's that the majority opinion tends to solidify into a dogma. And that's where we have to form the alternative scenarios, because the crowd is now entrenched in a particular view on the market, and it's a dogma, and there we have to figure out that that dogma is not going to work. We have to figure out what our alternative scenarios are going to be that allow the market to reverse from its current prevailing trend. Solidify into a dogma while its basic premises begin to lose their original validity and so become progressively more mispriced. And that, of course, is deciding when the crowd moves to an extreme. Because when the market is mispriced, and the valuation is excessively high or excessively low, that tells us that in the market action, the crowd has indeed moved to an extreme. So, looking at our 3 steps of forming a contrary opinion, let's discuss the first step, figuring out what the crowd thinks. How do we figure out what the conventional view is or what the crowd thinks? There's a number of different ways in which we can do this. For example, the media, television, print, and so forth, is good reporters are a great reflection of what's going on, because they're reporting the news and reporting what people think. So sometimes we can look at television programs, we can look at the news, we can look at publications, we can look at best-selling books and so on and so forth, and get a feeling for what the media is telling us, and what the media is telling us is really being fed up from the bottom and tells us what the conventional view is. One thing which we'll look at later on is cover stories in magazines. There's a lot of work been done on, say, Time magazine, and people look at the cover stories, and when we get a cover story on the stock market, typically that indicates that we're pretty close to a market turning point. That's not always the case, but it's usually the case. So we can look at cover stories as one example of what the media thinks. And the second is looking at valuation to see when things are getting overdone from the norm. Now, as you know, I'm a technician, but I use valuation methods. I look at dividend yields, I look at price-earnings ratios, not in the sense of the fundamental sense, but to look at the trends and the level of these things, because I can use the fundamental information just like I can use technical information. And when I see that the dividend yields are extremely low, that's an extreme measure of overvaluation, and that helps me to figure out what the crowd thinks by its very action in terms of the valuation. So when things tend to become extremely overvalued, that tells you that the crowd has probably moved to an extreme on the upside, and when it's extremely undervalued, as bonds were in September of 1981 when they were yielding 15 or 16%, that again told you that the crowd had moved to an extreme in the other direction. We can also, as technicians, look at sentiment numbers. These can be very, very helpful. But to give you an idea, I mentioned before that prices are determined really by the attitude of people to the emerging fundamentals rather than the fundamentals themselves. And I gave you the example of the Nifty 50 back in the 70s yesterday, and I mentioned that these stocks were called one-decision stocks because people used to buy them, and every year they would go up, and every year their earnings went up. They peaked out in 1973, came down in 1974, and even though most of those stocks, their earnings went up for the next 15 years, the average measuring the Glamour Growth Index, for example, didn't make a new high until the early 1980s. So the earnings were going up, and the prices were totally different throughout that period. They were still way down from the peak. So it was the attitude of people to those earnings which are important. And this is an example here of a banking stock up at the top, and underneath is the earnings. And you can see the earnings are going up here with the red arrow, and the price over this whole period is coming down. So it's the attitude of the people to the earnings on this particular stock which is important, rather than the earnings themselves. Because if you'd seen at that period where the stock peaked, and had you known that the earnings were going to rise for the next couple of years, you would probably have bought the stock. But it wasn't the right thing to do because it was the attitude of people to the earnings which was important, and the attitude was getting more negative as the price came down. And we see a similar situation up in the late 1990s where the earnings are going up and the price is coming down. Most of the time you'll find that prices and earnings will move together, but there are a lot of exceptions that prove that the rule is not infallible. eBay, for example, is an interesting stock because their earnings have been going consistently up. It's probably one of the best stocks on the internet. And look what happens to the price. The price is actually not doing as badly as a lot of these internet stocks, but it's down to slightly, sideways to slightly down, and yet the earnings are up significantly. So the only thing that's changed here is the fact that people's attitude towards those rising earnings has changed. They're not so optimistic towards those earnings now as they were back in 1998. One way in which we can show that sentiment and prices in the market are very closely intertwined is to compare two series. The first series is the bears as measured by Investors Intelligence. They can be found at chartgraph.com. And every week they take about 130 or 160 different newsletters and they figure out which of these newsletters is bullish and which one is bearish. And what I have done here is I've plotted the weekly number for the bears, and I've plotted it inversely so it corresponds with movements in prices. And what I've done is I've taken the closing price and divided it by a 13-week moving average, so that when the bears are the same, the weekly closing price is the same as the moving average, then you get a reading around a zero there. And when it's above the average, we have a positive reading, and when below, we have a negative. But underneath, I've taken exactly the same measure, dividing the close of the S&P by the 13-week moving average. So we have an identical oscillator for both series. And what you can see, if I just throw in these arrows showing the bottoms, they're not exact, but there's a pretty close correlation. And then if you look at the arrows indicating the tops, again, it's not exact, but there's a reasonably good correlation that takes place. So I can show you then that there is a correlation between sentiment numbers and oscillators. And that's very important because if we don't have sentiment numbers for something, and most of the markets we don't have sentiment for, we can substitute oscillators. And that's very significant. Here's another example. This time we're looking at bond yields up at the top, and they're inverted to correspond with bond prices. So just think of this as a bond price series. And underneath are the percentage of traders as measured or monitored by MarketVane in the US that are bullish on bonds. And underneath that is a 14-week RSI. And once again, I can bring in some arrows showing you the peaks in the bond bulls, and they correspond reasonably closely to the peaks in the RSI, and so do the troughs. So in the next chart, what I'm going to do is I'm going to smooth this out a bit so it becomes less complicated. Again, going back to my premise of keeping things as simple as possible. So in the next chart, it's going to show you a blue line, which is going to be the 10-week moving average of the bond bulls, and the red line will be the 10-week moving average of the RSI. And there we are. So what I can do, with the benefit of PowerPoint, is I can put some waves over the 10-week bond bulls. That says 10 days, but it should be 10 weeks. And you can see it's the same chart we saw before. And you can see that the waves correspond to the peaks and troughs in the bond bulls. Now what I'm going to do is I'm going to move those waves down above the 14-week RSI in the bottom panel. And, oh, it's not going to go down, is it? Okay, if you all concentrate very heavily, maybe we can make it go down this time, okay? Because we really got to concentrate because I was at a delicious lunch, but I'm feeling a little heavy from it. So are you ready? There it goes. Okay. So the point really, seriously, is the fact that these two things are pretty identical. And so we can use sentiment indicators that correlate to the, not only in the stock market, the bond market, so I've shown two different markets. So we can use oscillators to try and figure out, as a substitute for the sentiment indicators, so we can use the oscillator as a way of figuring out what the crowd thinks if we don't have the sentiment numbers with us. So again, looking at our 3 steps in forming a contrary opinion, what about forming alternative scenarios? Well, at turning points, everybody has taken action in anticipation of the known facts. So we have to figure out what are the alternative scenarios the crowd has failed to anticipate. And when we can figure out what an alternative, we can have maybe 3 or 4 of these alternative scenarios. And then if we're thinking the crowd has moved to an extreme, we can see one of these alternatives may be coming into play. And then as we can see that happen, so we can then take an investment position against what was previously the prevailing trend. So what are the possibilities? I'm going to look at several different markets and possibilities, just some examples of how we might work this out. Let's take commodities, for example. When commodity prices come up, typically what happens is people will substitute one product for another. I remember I used to live in Canada back in 1972-73 when there was a huge boom in commodity prices, and part of that boom was lumber prices. It came up in a terrific manner, became way above what they were a couple of years earlier. So people started, in their building, to actually substitute aluminum in certain cases, for lumber. So the idea is that when prices go up to a high level, people will substitute products wherever they can. The same thing will happen with capacity. If the price comes up, that obviously encourages the mines to put on more capacity, encourages, making paper, for example, and the price of paper goes up, it encourages the paper manufacturers to put in more capacity. Also encourages people to innovate, too, if the price gets up higher. So there's all kinds of things that can happen. These are all sorts of alternative scenarios that can happen when the price goes up significantly. Obviously, if it's going to go up 10%, it has no effect. We're talking about major commodity booms that take place where prices can quadruple or triple. Here's a great example of gold, for example. In 1980, gold had come from, $35 in 1968, all the way up to $800, $850 in 1980. What happened was that high price in gold encouraged a lot of mines to explore and also to come on with new mining technology, which at $200 gold was not very efficient, not very profitable. When it gets to 700 or 800, then they couldn't come on with new technology. It would encourage them to take new technology. And of course, what happened was I'm not saying that's the reason that the price of gold came down, but it's one of the contributing reasons why the price came down and went in a sideways trading range. But the other point on this chart here is that it shows you have this spike in this 12-month rate of change. And this typically happens, and we'll see quite a few examples of this, where you're looking at these longer-term rates of change, and when they build up some kind of a parabolic blow-off, that's typically a sign of a major peak in a particular market. So when you see something like this with the annual rate of change reaching up to some extraordinary level it hasn't seen for maybe 20 or 30 years before, that is an example of the crowd moving to an extreme, and a time you should be thinking about forming an alternative scenario. Bonds and high interest rates, when high interest rates go up, they kill the economy. So another way of looking for an alternative scenario is to look and see what stocks and commodities are doing in relationship to interest rates. For example, we know that when short-term interest rates go up, the stock market is usually reaching the top of a bull market. That's the kind of condition which has killed virtually every bull market in the US anyway, since the beginning of the 19th century, or even the 19th century. So one of the things to look for is the alternative scenarios is to look for rising interest rates. So if the stock market is moving up and everyone's moving and it's getting into an overvalued situation, everyone's extremely bullish, then the alternative scenario people may not have thought of is the fact that interest rates may start to move up, and that may crowd out the recovery. And if the recovery is crowded out and starts to move into recession, then obviously people in the stock market are going to anticipate this and sell. And this example here shows the Nikkei. Remember, it had a tremendous bull market in the 70s and 80s. And everyone kept saying when the Japanese bull market's overextended, it's overvalued and so forth, it should crash. But they were saying this from the beginning of the 1980s onwards, but it never stopped going down. It just continued to go on up. And one of the reasons was that, especially in the latter part of this, was that short-term interest rates were still coming down. And it wasn't until 1990 that you could see that short-term interest rates started to move up in Japan, cross above their moving average, and the stock market broke that uptrend line and also violated its 12-month moving average. So that was the first period during this latter part of the 1980s, since the latter part of the 1980s, where short-term interest rates were rising and the stock market started to respond by crossing below its 12-month moving average. Because if you look down at the other period when the short-term interest rates rallied, which was 1985, you can see the stock market still remained above its 12-month moving average. So by looking at the alternative scenario and saying when a rate's rising, okay, that's maybe when we can start to form this alternative scenario. And when the stock market confirms that by crossing its 12-month moving average or breaking the trend line, then we can put the whole thing together. And we can say that the crowd has probably reached an extreme in Japan, and the alternative scenario of the rising rates killing the stock market is probably going to take place. Another thing we look at is, if you look back in recorded history, you'll find in every business cycle pretty well, there are some exceptions, you get a chronological sequence between bonds, stocks, and commodities. Bonds are the first to bottom out, then stocks, then commodities, and then as we move into the recovery, bonds peak out, then stocks, and then commodities. Well, we looked at the relationship between short-term interest rates and stocks. That's the first part of it. The second part of it is when interest rates start to rise, sooner or later they'll go up and commodity prices will go up. And then at the end of the cycle, what happens is commodity prices will start to come down, and the next thing to look for would be a peak in interest rates. So in other words, if you see a period of sharply rising interest rates, which we haven't seen from a long time, of course, but if you do see a long period of sharply rising interest rates, and it looks like they're never going to stop going up, one of the alternative scenarios is that the interest rates will go higher. That will cause the economy to lose its growth rate and go into a recession. And before that happens, or as that's happening, so commodity prices will peak. So commodity prices will peak before bond prices. So the alternative scenario then is to look for periods, as we're doing on this chart here, where we're joining the peak in commodity prices to the peak in bond yields. And you can see most of these arrows shift to the right, indicating that commodity prices lead bond yields. So again, what we're doing is we're saying interest rates are going up, and what we have to do is to say what's the alternative scenario. And the alternative scenario is that commodity prices are going to come down, and when they come down, interest rates will sooner or later follow. And you can see in this chart that in most of those periods there, that sort of analysis worked. Another form of alternative scenario would be in companies, for example, where it's widely known that the management is extremely weak and the price of the stock's been coming down, everybody despairs. Well, the alternative scenario, of course, is that the management is then replaced, get new management, and the whole scenario changes. It may be, for example, that there's a key man, a key CEO in a company who is a sort of flagship for the company, and he may unexpectedly get killed in a crash. Well, the price of the stock comes down because of that, because they feel that once that guy's gone, the company's going to go bust or is not going to do very well. But the alternative scenario then is to say, maybe this guy is smart enough to have anticipated something really bad going on, and he has placed good managers as people who can take over from him, so you get unexpectedly good continuity. That is the alternative scenario in that kind of situation. A lot of the times in the 80s, we saw a lot of banking crises. The alternative scenario, and so you think that the whole financial system is going to collapse, but typically what will happen, the alternative scenario, is that the government will come in with a rescue package. That happened in the bear market of 1982. In the summer of 82, everyone was afraid that Mexico was going to default on its debt and go under, and it had huge, huge debts. But what happened was we had a government package. That was the alternative scenario that took away that particular worry from the market. And in the 1980s, we had a similar thing with the S&L crisis. Once again, what was the alternative scenario that could have happened was that the government came in with a rescue package. So there's all various ways in which you can think about alternative scenario. I'm just giving you a few random examples there with a few technical examples of how alternative scenarios can come into play. And obviously each situation is different. The one with the stock market and the interest rates and the one with the interest rates and the commodity prices will work pretty consistently over long periods of time because these are established intermarket relationships. The others are more isolated examples. So then we have to decide when the crowd moves to an extreme, because when the crowd moves to an extreme, as I pointed out in that first example, when it moves to an extreme, that's the time when you should expect to see a turning point, because during the trend, the crowd is usually right. So one of the things that's important about when the crowd reaches an extreme is the change of attitude that people have and the questions that they ask. When the question is no longer whether, but when and by how much, that's when you know the crowd has moved to an extreme. Because if the crowd says, well, is the gold price going up? There's some people who don't know whether the gold price is going up and some people who think the gold price is going up. But when everybody says, well, how soon is it going to get there and what level is it going to reach, the decision of whether the gold price is going up is already made by everybody. They all know it's going up. It's just a question of how it's going to get there. And when you take away that question of when, then you know that the crowd's reached an extreme. And sometimes you can discern this kind of stuff from articles, and sometimes you see it from the media. But it's a very important point that you've reached when the question changes, not from when, but not from whether, but when and by how much. Some ways you can find this out are by unusual events. In 1980, for example, when gold was reaching a peak, there were reports in the Canadian newspapers of people actually lining up at banks to buy gold. Now, that's never happened before, and it's never happened since. Why were all these people lining up at the bank counters to buy gold? Well, that's because the crowd had reached an extreme. They'd seen this gold price go from $35 up to $800, and it had become, there was a good rationale for it at the beginning because of inflation, and gold discounts inflation. But it had got into a dogma, and gold had got progressively more and more mispriced, and that was an indication that the crowd had reached an extreme. Same sort of thing happened in October of last year on mortgage refinancing in the US. This was an article that appeared in the Wall Street Journal, and it was about mortgage financing. And it was saying that this is a great time to refinance your mortgage if only you can find a lender that wants your business. They're in the business to lend money. So why would you have difficulty finding a lender? It's because they were overwhelmed with mortgage applications. The second yellow highlight there says the result, some borrowers are having a hard time just getting through the door to borrow this money to refinance their houses. U.S. Bancorp's toll-free lines are told their calls will be returned in 2 or 3 days. Normally it's an instant thing when people return them, or they pick up the phone and answer the phone. But this has obviously got to an extreme. And then it says here, at the very bottom here, the phone number of your loan officer is a precious commodity. Well, that's very, very unusual. I've never seen anything like that. And it really drew my attention to the fact that maybe the bonds are reaching a peak here. And here's a chart of the bonds, and that really represented the peak back last October. And so far, bonds have not taken out that October high. The 10-year bonds have, but not the 30-year bonds. And so they've been in basically a sideways trading range. So it's not exactly played out. I can't say that crowd moving to an extreme has actually worked its way out here in terms of a major peak. But certainly bonds have not yet taken out that high. And you can see from this moving average of bond bulls that it was up at a pretty high level a little bit after that. In fact, I've got these numbers going back 25 years, and that's the highest level I've ever seen it at. So clearly there is, at that time and currently, there is a tremendous amount of bullishness towards bonds. So sometimes you can figure out that the crowd's reached an extreme by invisible markets being featured on the network news. What do we mean by invisible markets? Well, when you listen to the evening news, you often hear about the stock market going up or going down after a fairly dramatic move. But you rarely ever hear about sugar or coffee or something like that occurring. That's what I call invisible market because it doesn't usually appear. And in 1980, for example, I was listening to the CBS Evening News, and there was a guy called Ray Brady who used to be a great financial correspondent because he could always find out when the market was going to peak and trough. He didn't know it himself, but he had a great nose for reflecting when markets reach an extreme, which is what a good journalist should be able to do. They're not in the business of forecasting, they're in the business of reporting. So a good reporter will often come on the news at a critical time when the crowd has reached an extreme. Well, he was telling us that people, and they had the usual shots of people in the sugar pits and everything, saying, well, sugar's, it was about 60 cents at the time, up from about 10 a year earlier or so. And he was saying, well, the sugar price is going to go up and everyone's going to have to pay more price for sugar, and that means confectionery is going up and candies and sweets and so on and so forth. Because that was basically the day of the high. But that's what I mean by an invisible market appearing on the national news. Sometimes you'll get in some of these magazines like Time and Newsweek, for example, you'll see what I call foreign markets. In other words, non-US markets. Maybe it's some emerging market in Asia or South America or something, which is featured in the magazine. That's an invisible market because you don't normally read about that stuff. And the only reason you're reading about it in magazines such as Time or Newsweek or one of these other magazines is because it's really making a lot of news locally, and the market's already moved, that particular market's already moved a long way. And that's indicative of the fact that the crowd in that particular market has probably moved to an extreme. Finally, the coffee prices in 1997. I have a chart here, and I remember driving along, listening to the news on the radio, and they were saying that Starbucks had just raised the price of coffee, and someone else had just raised the price of coffee, and that was just a beginning. It was likely to go up much more. And that was right at that point just there. And I called my broker and I said, well, I think we should be shorting coffee. And he said, no, we're actually long. And I didn't do anything on it, but it appeared to me that was a great place for expecting a change, because you don't normally hear coffee prices being discussed on the network news or on any news. This is what I call an invisible market. And if you'd looked at the technical position, you would have seen that, first of all, that not at the point when the announcement was made, but a little bit later on, the coffee price created and broke down from the top, and also the 39-week rate of change had also broken down from the top too. So based on the stuff I was telling you in the earlier presentation, this would have been a classic sell signal, because the oscillator was telling you it had made a top, and that was then confirmed by the price. So that's what I mean by invisible markets, markets that don't normally appear on these particular programs and things. One of the classic indicators, a lagging indicator, I really love these guys, are the politicians. Because when they get involved, you know it's the end of the trend. I mean, that's every time it seems to happen. So they're a great indicator, and I love them dearly. The best instance I can think of this was in 1981, in September 81. I was sitting down watching my TV, and there were all these congressmen coming back, or congress people, I guess they are, coming back from their summer holidays. And interest rates were at a pretty high level. And they were all saying, we've got to do something about interest rates. You know, not just one of these politicians, but loads of them were coming on saying, we've got to do something about interest rates. This is absolutely terrible, so on and so forth. So they really got the message from their constituents. So in other words, they were reflecting what the conventional view was. And the conventional view, it obviously was scared stiff about these rising interest rates and wanted someone to do something about it. And so if you look at this chart here, that was the time when they were coming back, right where that arrow is. And technically speaking, you can see that the interest rates bond yields made a small peak there, and also the rate of change there made a small peak as well. So again, you get this kind of a confirmation of seeing the crowd reaching an extreme, if you will, in terms of what you see on the news, and then putting that together with the technical position saying, hey, the thing is extremely overbought, and not only that, but the price has already completed a top. So the top was completed a little bit after that September period, obviously, because the top's not going to be completed the day of the high, but at least that gave you a warning that we had reached an inflection point. And if you were short bonds, you better start covering because there could be an important turn coming. Another example of a politician was Jerry Ford back in 1974, just after he got into office. And this is the inflation rate. And he'd been really quite concerned about inflation, so he came out with these WIN buttons, which stood for Win Inflation Now. We were all supposed to wear these buttons to combat inflation. Well, the buttons didn't do a lot of good because that was where they came out, right at the top of the annualized rate of consumer price inflation. Another classic example of politicians figuring out what the crowd thinks and giving the crowd what they want, lower inflation. A final example here is a Bill Clinton example. This is crude oil, and at the 2000 election, the price of oil had been coming up very sharply in this whole period just here, and there were calls for reducing or releasing some of the strategic oil reserve which we have in the U.S., and that's exactly the point of the high, just slightly before the election. I'm sure there was no connection. And that was the point where they started releasing the strategic oil to try and get the price down, or to stabilize the price. But of course, that was a time when everybody had anticipated the good news in terms of the bulls, and it was time for a reversal. And so you can see it broke the uptrend line, crossed below its 12-month moving average, and look where the 18-month rate of change was. It was pretty high, and also later on completed a top. So when the politicians get involved, the market, typically that'll be confirmed by a market being overbought on an annualized or 18-month rate of change basis or something, and then you need to look around and see when the price crosses below a moving average or breaks a trend line, and that just confirms that whole psychological thing is about to reverse. Other ways in which you can figure out where the crowd's at an extreme is to look, as I mentioned before, for cover stories. There was a famous cover story in Business Week in 1977 called The Death of Equities. Well, of course, after that, equities just rose and rose and rose, as we all know. So here's a couple of examples of other cover stories by Business Week, which is also a really good indicator for us. And this was called, this was around, again, the same time as when the politicians were coming back and being reflected from their constituents. And this is Business Week cover story called Interest Rate Anguish. And just by seeing the cover story, made one think, well, this is probably the peak in interest rates. But in order to confirm that, because sometimes contrary opinion can be early, what we need to do is to see what the technical position is. And this is a very simple model again. And before we do that, I'll just do one other cover, and that was the cover story of disaster in bonds, and that occurred right at the bottom of the market just there. So on the first one, and that's this one here, interest rate anguish, you can see the bond market formed a base and broke out on the upside. And you can see that the 18-month rate of change, like in that trend line example I was showing you in the previous presentation, the oscillator broke above the trend line, creating a beautiful base. The price also confirmed by forming a base. So we had some really good evidence here, especially combined with the Business Week cover story, that the crowd had reached an extreme and the technical position was confirming that it was coming back from that extreme, and so the trend of prices was likely to be up. The other one over here, where you had the disaster in bonds, you can see that the oscillator was oversold. Not such a clear-cut signal in this case here. There was no base formed or anything. It was just approaching the oversold level. So you knew it was ripe for a turn, but really nothing else in the momentum indicator to give us a good, really solid signal. But in terms of the price, you can see the price moved back to the top of that base that it had broken out from several years earlier. So you're moderately oversold or pretty oversold, and you'd reach support. And usually when you find a market that's reached support and it's oversold, it's usually ripe for a turn. And in this case here, I think we can draw a little trend line joining those peaks. And when it broke above that trend line, it was confirming the oversold situation and confirming that the support had held. Here's another example of a couple of cover stories here. The first one is the CRB composite, which is heavily weighted towards weather-driven items. So when we get the drought being reported on the network news, it gets a lot of attention, because what's happened is the price has already come up in anticipation of the bad news. And really what's happening here is the price, the rise in the price is really the thing which is attracting the news story on the network news, because normally you don't hear about droughts and commodity prices and that sort of stuff on the network news. You can hear stock market stories, but not usually that. And at the same time, you can see that the 52-week rate of change was once again overbought. Over here on the right, in The Economist, which people often think of as being always on the ball and good in terms of forecasting, Economist covers also tend to be good contrary indicators. And here we had one on global crop shortages, and it occurred literally on the week of the high. Once again, we can look down to the 52-week rate of change. Not a classic way overbought signal, but it certainly hit the overbought line. And again, putting the two together, you could have come to the conclusion that commodity prices are probably reaching some kind of a peak. Now we're looking at the S&P composite, and we're looking at the discount rate inverted. So in other words, we're looking at the S&P composite and money market prices. And just at the beginning of the 1982 bull market, there was a cover story in Time called The Birth of the Bull. Now, as a contrarian, you'd say to yourself, well, here's a cover story calling it The Birth of the Bull, and it's occurring as the market's going up. So if that's a cover story, it's reflecting a lot of bullishness, but it must mean this bull market's not going to go very far, because it's a cover story. From a contrary opinion, I'll go short. Obviously, looking at the chart, that was the wrong impression to have had. And the reason why it was wrong was because usually when you get one of these cover stories, it occurs when the market's overbought, long-term, way overbought. In 1982, it was just recovering from an oversold situation. Usually when you get a bull market peak in stocks, it's because interest rates have started to rise. In this case here, or money market prices have started to fall. In this case here, money market prices are starting to rise. So the conditions were not right for the cover story to work, which is why you have to sort of use some common sense about this thing. You can't say, well, as a cover story I'm bearish, or a cover story I'm bullish. Most of the time you can, but you have to look into the general context about how that cover story arose. In this case, it didn't arise because of rising prices and money market prices falling and interest rates rising. It was a completely different situation. On the other hand, we look at another cover story called The Future of Wall Street, which occurred in the fall of 1990, just after a pretty dramatic collapse in stock brokerage stocks. And here again, one of the things about stock brokerage stocks, and this is now we can use this as a contrary opinion, because when interest rates are falling or money market prices are rising as they are here, that tends to be bullish for stockbrokers. Also, when the market itself is rising, that tends to be bullish for stockbrokers because they get more volume and they can do more underwriting and so on and so forth. So the conditions in 1990 were ideal for stock prices, for stockbrokers to go up. Although what we were seeing in the article was the future of Wall Street, questioning whether Wall Street was going to continue or whether brokers could continue to do well. So what happened in the next few years was that the Wall Street stocks, the brokerage stocks, outperformed the market by a considerable amount. So there's an example where the cover story did hit at the right time. After a dramatic decline in stock brokerage stocks, they were oversold, and at a time when interest rates were starting to fall and money market prices were starting to rise. So monetary policy was bullish, which is bullish for brokerage stocks. This is a cover story now on Amazon.com in December 14th, 1998. And here is the stock itself. You don't get too many cover stories on Business Week of individual companies, but when you get a cover story on an individual company and you can see that the price has already risen a tremendous amount, the cover story is there to sort of reflect some great success story and the fact that the price is up. And in this case here, Amazon stock had gone up incredibly quickly in the previous 2 or 3 years. So if I just show you where the article was and show you what the stock did, that was not quite at the top, but it was certainly telling you that we'd reached a pretty frothy level in terms of the Amazon stock. Another way you could figure out that crowds are an extreme is with what I call thin read indicators. And I'll give you an example of this. Back in the 1980s, there was a fellow called Leon Dworsky who used to run a contrary fund in Fidelity, and he wrote an article in Worth magazine, which is a Fidelity-sponsored magazine at the time. And he pointed out the fact that back in the 1980s, he'd received a memo from one of his brokerage companies he used to use, and they were saying that Campbell Soup coverage, research coverage, was being discontinued because they were expanding their coverage of consumer stocks. But if Campbell Soup isn't a consumer stock, I don't know what is. The point was that Campbell Soup had doubled in price between 1958 and 1962, and had then basically gone sideways to down over the next 15 or 20 years, and yet in each of those years, except one, their earnings had gone up. So by the time the report came out, this stock was offering incredibly good value relative to where it had been in 1962. So they were stopping their coverage of Campbell Soup basically because, as a research brokerage house, you're trying to sell research someone's going to buy. So you're not going to discontinue it if a lot of people are buying the research on Campbell Soup. But if nobody wants to buy the research on Campbell Soup, what does that tell you? There's a total disinterest or lack of interest in Campbell Soup. And so from a contrarian point of view, that's probably the time when you should be thinking about buying it, not thinking about stopping coverage. And over the next few years, Mr. Dworsky pointed out, the stock went up 9-fold. So that's what I call a thin read indicator. It's not something you can put your hand on and say, okay, that's a buy or a sell. But when you think it through, there's obviously something more important going on than would appear on the surface. And that was the fact that these brokerage houses couldn't sell research on Campbell Soup. And if they couldn't sell research to the institutions weren't concerned. And yet at the same time, you can point to that and say that was a great value situation, which it was at the time. Best-selling books are another indication of when the crowd's an extreme. In 1968, Adam Smith wrote a book on the stock market, which right at the height of the mutual fund bubble, and it went into the bestseller list. One of the most amazing books in the bestseller list I've ever seen is William Donohue's book on money markets that reached the bestsellers for nonfiction in 1980 and 1981. That was right at the time when money market rates were up at the I don't know what the actual level was. It was right up at their secular peak in that September of 1981 period when the politicians were coming back. Well, no one has written a book on money markets since or before that I know of, and certainly it's never reached the top best-selling list. So there again is an example that money markets, because the interest rates were high, everyone was getting involved. It was clearly an indication that the crowd had moved to an extreme, and that we should expect to see some kind of a decline in interest rates. In 1987, Ravi Batra, an economist, wrote a book about the next depression that was going to take place. That book got into the bestseller list right after the 87 crash. As we all know, there was no depression during the next 10 or 15 years, and so that was a great contrary indicator. And even back in the 1920s, Edgar Lawrence Smith wrote a book about common stocks as long-term investments. And he wrote this book pointing out that, contrary to what people had thought prior to that, that stocks were the place to be rather than bonds. And it got into the top list, bestseller list. And this is right towards the top of the 1920s bull market. So again, it reflects the psychology of people. When everyone's buying all these books, they're all interested in that particular market, whether it was the money markets, whether it was the stock market like in the 20s, or Adam Smith's book in 1968. They all represented very, very important long-term inflection points in these particular markets. Another way in which you can figure out whether a crowd reaches an extreme is to look at unrealistic valuations. Japanese real estate prices in 1990. Remember I showed you that peak in the Japanese market in 1990? I forget the exact quotation or statistics, but people were going around saying that the real estate in that the Emperor's Palace was in yen was worth as much as California or half of California or something. There were some absolutely ridiculous valuations when you compare Japanese real estate values to what we would get in the US. And that's a good example of when the crowd has reached an extreme. Tulip mania in Holland a few centuries ago is another example. And of course the US stock market in March of 2000 was a classic example. So why is it difficult to go contrary? Well, one is we all have a need to conform and we don't want to look foolish. And here's some examples. Say, for example, at a corporate meeting and the boss has one view and we have the other. We might want to go against the boss a little bit, but not too much. So we don't really want to go contrary there because of the pressures. We also don't want to appear foolish in the light of the obvious facts. When everybody thinks a certain thing is going to happen, you kind of feel foolish if you stand up and say, well, I think something else is going to happen, unless you have a good rational reason for it. So we tend not to want to go contrary. Also, if the trend is well established, the psychology of most people is that it's bound to extend, because we're always trying to extrapolate the recent past and can't really bring ourselves to thinking that the trend is going to change. And if you're a forecaster and you get an extended trend, you may have called a couple of reversals, but you're a little bit early, because contrary opinion can sometimes be a bit early, so you're reluctant to make and repeat that same mistake again. So these are all reasons why it can be difficult to go contrary. Also, you sometimes meet hostility, and because there's a fear of being criticized by others for positions we hold. A good example occurred in mid-1980s. I wrote an article in Barron's calling for the bond market to rally on a secular basis. I figured that yields had bottomed in 1981. By 1985, I figured that we'd had enough technical evidence to forecast a technical rebound in bonds. And in the same edition, well-known economist in Wall Street, Ed Hyman, was interviewed, and he was of a similar position. He was in a very deflationary type mode. And the next week in Barron's, somebody had actually, and I haven't seen this anywhere else in Barron's, somebody in the letterbox and writing to the editor had written a poem about Ed Hyman and myself and pointing out how the money supply was exploding and how we were out of our minds to be bullish on bonds. But that's an example of sort of a, not exact hostility, but it was certainly a sophisticated way of someone to coming up with their alternative view. But Bob Prechter, a well-known Elliott wave theorist, wrote an article in late 1980s on gold, and it was a bearish article when gold was around $400. And the next week in Barron's mailbag, there were about 3 or 4 really nasty letters criticizing him for his article on gold. Well, the fact they were so adamant in criticizing was itself an indication that Prechter was probably right, which of course he was in that particular instance. So when you go contrary, typically you will meet a lot of hostility. Also, you're disturbing the comfort of conventional positions when you go contrary. And we also have a natural tendency to believe the experts. So what is the motive of the expert? That's what we must examine. Well, first of all, we have to ask ourselves the question, is the money manager being interviewed, is he long the stock? If he's long the stock, then obviously his view is not really objective. It could be a brokerage analyst who's bullish on a stock because his house is underwriting that particular stock. Once again, it's the motive of the so-called expert, but it's not the right motive. It's not an objective view of what's going on. and sometimes the CEO, when he's on being interviewed, will have a vested interest in pushing his company's stock higher. He may have options and so on and so forth. So the motives of a lot of these experts really should be questioned a great deal. And of course, government officials very, very rarely, occasionally they'll paint a bad picture, but usually they'll point a rosy picture of whatever the facts might be. But we have a tendency to believe the experts because we feel that the establishment has more facts and resources at its disposal. Remember the Vietnam War, for example. That was a war where the government, the so-called experts, went into a war, and it was obviously a major catastrophe and mistake. Same thing with Neville Chamberlain, with Peace in Our Time, signing that agreement in Munich. You think he has all the answers because he's got all the facts at his disposal, but of course he was wrong. And then the Soviets going into Afghanistan, another example of where the experts were wrong. But we feel more comfortable when a successful person reassures us because they know what's going on. But I believe it's more events rather than people that are in control, and I think 9/11 was a great example of how events controlled what was going on rather than the people in the establishment. That's an example of 1929. We'll see what people were saying at the peak. A well-known economist, Fisher, said stocks are at a permanently high plateau, and that was literally right at the peak. Another expert, John D. Rockefeller, who'd have a lot of confidence, the man had made a lot of money, you'd think he'd be right, he said, I've been purchasing sound stocks. This is towards the end of the crash. And Jesse Livermore said this should go on no further. That should be the end. That's the end of the bear market. Well, that's what happened after that. So you can't always believe what the experts tell you. One of my heroes is Roger Babson, and he said, I'm certainly optimistic about this fall. Well, obviously, if he was optimistic, he had to be short about the fall. So now I'd like to give you some examples of some expert commentary and see how that played out in the markets. And these were brought to my attention by my colleagues at the former colleagues at the Bank for Analysts in Montreal, who do some great analysis. And then what they're doing is they're quoting some of the major publications from the Federal Reserve. And these quotes are occurring at the end of the 1969-1970 recession. And it says almost every major industry cut back on its workforce in October. The October numbers are worse than they look. And that was the Business Week in November of 1970. Then we have another quote. Around the same time, there were few business people who expect a turnaround before the end of 1971. That again was a November Business Week quote. And then two more quotes from this period. The staff projections still suggest that the average rate of growth in the real GNP over the next 3 quarters, ending in mid-1971, would be relatively low. And that was the Federal Open Market Committee. And then Mr. Paul McCracken, head of the Council of Economic Advisors, is telling everyone, including the President, that the job of re-stimulating the economy would be more difficult than most people thought. So these are November, December of 1970. And what happened afterwards was the recession trough was recorded in November as those quotes are being written. Real GNP rose 9.5% between the fourth quarter of 1970 and 1971. And a little bit later on, I'll show you the graphs of how you could have used technical analysis and so forth to have identified some of this as being incorrect. Looking at the same type of thing in the end of 1973-74 recession, we have The Economist magazine. The economy, frighteningly, seems to be going its own way, shrugging off the help being doled out by the administration. Another one by The Economist. Whenever the upturn in the American economy comes, it will not, according to even the most optimistic predictions, be before the summer. This means that at least 4 more months of dire economic statistics telling much the same story of deepening recession as the latest February figures. Sounds pretty awful. Then the Federal Open Market Committee, around the same time, staff projections like those of a month earlier suggested that real economic activity would recede further in the second quarter. And then finally, Business Week, it is yet far from clear when the recession will bottom out and how far down the low point will be. Not a question of whether, but when and by how much. Crowds reached an extreme. So what happened next was that the recession trough was recorded in March of 75, and the real GNP rose 13.5% between the first quarter of 75, when those quotes were given, and 1976. And one final one, the end of the 81-82 recession. The battered economy isn't picking up yet. There are still very few signs that business is picking up. Business Week in November of 82. The Economist. The Fed's view is that without some stimulus, economic activity will not pick up in the near future. The 1% rise in real sales in September was mostly clearance sales of cut-price cars. And the last two quotes from the Federal Open Market Committee, the STAR projections still suggested that the average rate of growth of real GNP over the next 3 quarters, ending in mid-1971, 81 that should read, would be relatively low. And any recovery in the months ahead is likely to be limited. Many members continue to stress that there was substantial risk of a shortfall from their projection. Considerable emphasis is being given to the continuing absence of evidence that economic recovery may be underway, and this is what happened. The recession trough was recorded in November of 82, and real GNP rose 10.5% between the fourth quarters of 82 and 83. Let's just take a look at some of the charts that show this. These are the points where, at the top we have the coincident indicators of the economy, and underneath is the S&P composite. And these are where those 3 sets of quotes were given. And you can see they all appeared as the economy was bottoming. So in other words, when the economy is bottoming, you really want to see, one of the prerequisites from a contrary point of view is that most people are bearish and most people can't see any of these alternative scenarios. We'll just take a look at a couple of these alternative scenarios as we move on. First thing to bear in mind is that one of the first things that moves in the economy is housing starts, because housing starts are extremely interest sensitive. And as you can see in this first quote here that took place, housing starts had already started to pick up. They'd already bottomed before the quote was given. And there was no lead time in 1974-75, so we'll give that one a free ride. But again, in the next period, housing was in a bull market by the time those quotes were made in the end of 1982. And of course, the coincident indicators then bottomed out. Now we can look at interest rates versus the market in these same periods. And this is the first quote just here at the end of 1970. And you can see that money market prices, because money market prices lead the economy, money market prices had bottomed out. And technically speaking, you could see that the rate of change had broken above that downtrend line, and the stock market had crossed above its 12-month moving average. Then if you move along to the next one, that's when the quote was made by that vertical red line, and you can see that the momentum had bottomed out, money market prices had already bottomed out, and in fact broken a downtrend line, and the stock market had crossed its average, its 12-month moving average, in January. And then finally, in the 82 quote, you can see that money market prices had bottomed out a full year earlier than those quotes. A really staggeringly long time. And one of the things I found is that the longer the lead time between the low in interest rates and the low in the stock market, generally speaking, the stronger the rally in the stock market. Because basically those declining interest rates tell us that the economy has been correcting for a long period of time, and that corporations have had a substantial amount of time to lower their break-even points. So when the volumes start to pick up, then that goes straight through into the profits, into the bottom line, and that's very good for stocks, of course. And then the stock market, it crossed its 12-month moving average in August. Also, why it's difficult to go contrary is we have a tendency to extrapolate the past. We often forget that conditions can and do change. The problem is that they often change a lot more slowly than most contrarians would like. Often you get a lot of new era thinking in these periods. During the 1980s, for example, we had no recession from 82 to 1990 in the US. But in the middle, we found that there was a recession or almost a depression in the inflation and Rust Belts. And so, but on the coasts, things were okay. So the strong, California and the East Coast, the strength in those areas was able to more than outweigh the weakness in the rest of the economy. So people came up with a view that the economy was going to roll and continuously roll and self-correct, and there would never be another recession again. Because when the Rust Belt started to move up, then the coast would come down, and then the Rust Belt would go down, and so forth. It was a way to rationalize what was happening. But it proved to be inaccurate because, of course, we had another recession in 1990. And sometimes you see quiet summer markets where nothing appears to be happening, so we tend to extrapolate that recent past. And that happened in August of 1982, when we had a really quiet market, and suddenly, when everyone's on holiday, the market exploded. And the same sort of thing happened in 1984. So these are reasons why it's sometimes difficult to go contrary, because we extrapolate the recent past, and we kind of complacently think that's all going to continue into the future, whereas in fact, we should be looking at the technical position and perhaps coming up with some reasons why that's not going to happen, why it's going to change. Here's an example here of gold. And gold was all over the news in 1980 as we were talking. But at that time, who'd heard of the NASDAQ and who was really interested in stocks? Gold was all the rage. Well, if you extrapolated that trend, you wouldn't have been very successful, because back in 1998, no one was interested in gold. The stock market, the NASDAQ was really high, and people were really interested in stocks. And there were very few. A lot of the brokerage stocks had really cut back on their gold analysts, and that was, again, a classic indicator that we'd probably reached a bottom in gold, because if they were counting their gold analysts, that showed there was no interest in gold. If there was no interest in gold from a contrary's perspective, that should mean that the market was not just oversold, but probably sold out, and we should expect to see some kind of a major rally. Contrary opinion can also be too early. That's another reason why it's difficult to go contrary. Many forecasted the crash in 1927 and 1928, and they gave up by the time 1929 took place. And I think we had the same thing recently in the US stock market in the 1990s, because major trends take a long time to reverse, and valuations move to even greater extremes than we would normally expect. And with technical analysis, maybe we see a couple of divergences, we get bearish, but then there's an extra divergence and the extra divergence. And by the time we get to that final divergence, we kind of give up and say the market is not going to come down, and that's the time when it does. Here's an example of how valuation can move to an extreme, more than we would expect. This red line shows a 3% dividend yield on the S&P. And typically in the past, going back to the beginning of the century, when the dividend yield got to 3% or less, that was a good indication stocks were overvalued and that the market was going to top out. Then we had 1987, where we reached a record high and a quick move down. So again, that 3% level had been reasonably timely. But following that, yields continued to decline into the 1990s, so that by the time we got to 1998, the yield on the S&P was only 1.15 or 1.10 or something like that. Incredibly low yield, indicating incredible valuation. Now, anybody following this valuation stuff would have concluded around here that the market should be peaking out, and around here that it should be peaking out. So by the time you get up to here, you're thinking to yourself, well, valuation doesn't matter anymore. And of course, that's the time when the crowds reach an extreme when you should be expecting it to turn. And a lot of times when I'm looking at valuation, what I'll do is I'll take a rate of change of something like this, because I think that's a better reflection of valuation than the valuation measure itself. When it gets to be an overbought level, that usually gives me a better indication. If I'm looking at an actual number, I'll probably run a moving average through the valuation. When the valuation, in this case, crosses below the moving average, that's the time I would get my sell signal. Because how do I know, looking at this, that once it's gone up to here, that's not going to be the peak, or that's not going to be the peak? But if I run a moving average through and it crosses through the moving average, there's no guarantee I'm going to be right, but it suggests once the market builds up that kind of parabolic curve in terms of the valuation, that it's not going to be able to maintain that for any longer if it crosses the average. So the contrary opinion prerequisites are, first of all, that the original premise solidifies into a dogma, the premise loses its validity, and the market gets progressively more mispriced. Let's just take a look at what happened at the top of the bubble in 1998. And I'm going to show you a series of cover stories, and I apologize, somehow I wasn't able to get very good quality pictures in here. That doesn't take away from the analysis, though, because these are really spot on. So this is in the summer of 1999, summer and fall of 1999. Bill Gates, of course, an icon of technology, hits the cover of Newsweek. Why we take risks was in time. Obviously, if you look at the market, we were taking a lot of risks. Internet IPO, another cover story on the internet, Business Week. The eBiz 25, another cover story. Newsweek, eLife. I mean, there are so many cover stories in all these magazines as we come from the late summer into the fall of 1999. And that's where we were at that point just there. Then there was GetRich.com, another Time cover story. Business Week, the internet age. I've never seen so many cover stories on a subject so concentrated as I saw on these. And yet, the market still went up a little bit more before it went down. It went up to, was about 2,600 there on the NASDAQ, and it went up to 5,000. So it still had a very big, one more pop to go just after those cover stories. But looking at the technical position, you could see that it was building up a parabolic curve on the 18-month rate of change. And that's pretty important because it got up to, and then it crossed its 12-month moving average, which confirmed what the parabolic was doing, what the rate of change was doing. Then we can draw a line along here, right at the top of that rate of change, because it's important to note that that line is at 180%. In other words, what that was saying was the NASDAQ rallied 180% over an 18-month period. And that's historically a very, very high number for any market. And what we'll do is we'll compare the NASDAQ to other bubbles. Here's 1929 in the S&P Composite, and the brown line's at 140. And then we have the blue line, which was actually the peak in 1998. So you can see that the S&P was nowhere near getting the kind of bubble that the NASDAQ had. But there's the NASDAQ at 180%, where it was in March of 2000. And you can see that the S&P in 100 years of history, over 100 years of history, never even approached that 180% level. The highest it got to was 140%, and that was actually coming off the low in 1932. It wasn't at the high. Then we can look at gold in 1980. Again, we see this parabolic run-up. And look at the rate of change. The rate of change here is at 180%, which is exactly where the NASDAQ was. So again, these rates of change, as I mentioned before, are reflective of the psychology. And when they reach this parabolic blow-off phase, typically when they peak out, typically that's when the crowd reaches an extreme. So if you ever see a market at 180%, you know that it's approaching an extreme. It may be only 2 or 3 months away, but it could get up to a little bit higher than 180. I think gold got up to 200, 240. But you knew that it was, if you'd been studying this analysis, you would have known that it would have been pretty close. Here's platinum, again in 1980, again a parabolic rise. And there's the 180% level. And what happens after the market reaches remember you saw on gold, it reached 180 or higher than 180, and the gold went down and then sideways for 20 years. Same thing with platinum. Went down, it's gone sideways. It still hasn't taken out that 1980 peak yet. This next chart, we probably should close the doors so you can't leave, because I think it's a very serious one. It's a chart of price-earnings ratios. You may not have this in your book, because I slipped this in last week, I think. It's a chart of price-earnings ratios going back to 1881. And the reason I'm showing this to you is because if you look here, you can see I've got 3 boxes, A, B, and C. And each of those represents a period of overvaluation when the price-earnings ratio was extremely high. And you can see that and this is a very long-term chart, so you can see that each of these boxes was followed by a decline to where the market got into a undervalued state at the bottom of those boxes. You can see also that the latest rise, number D, was the highest it's ever been in terms of the price-earnings ratios. So what I did was I looked at those boxes and I related them to the stock market. And in 1901, that's when we saw the first box A, when the market was overvalued. And it was 25 years before the price, or before the index, got back to a new high. It was actually 1921 at this low here, well, that was really the low point just here. So the market corrected, not by going down like it did in 1929, but by going sideways. And as it was going sideways, so the valuations, the price-earnings ratios came down, so the valuations got better. But it was a psychological adjustment that took place. And this is really the point of showing you this, is that when you get to one of these parabolic blow-offs and one of these extreme periods, the pendulum, the psychological pendulum, moves from this way over to here. So from overvaluation, extreme overvaluation to extreme undervaluation. And these things take a long time to bring about. Here's 1929, where the decline was only 3 years. That was the next level of overvaluation. But it took 25 years before 1929 was beaten on the upside again. And then 1966, we had a similar situation to what we had in 1901 to 21, where the market went sideways, this time for 14 years before it made a new high. But if you adjust the market for inflation, which is what we do in the lower chart here, and there was the 1966 peak, you can see it took 25 years before we got back to the same level that we were on an adjusted basis. It was not until the early 1990s. So when you get to these periods of extreme overvaluation, it takes a long, long time to come back to where you were. And there we see the latest peak. We obviously don't have 25 years of history, so I can't say it's repeated again. But obviously this is a much more serious top than we've seen since 1966. Now I'd like to finish up with what I call 7 market myths. One myth is that you should believe most of what you hear and read. The reason I believe that's not true is that if we're reading newspapers, journalists have a need to rationalize price movements. They need to make a story interesting, and so they do this usually with some kind of, not a lie, but an exaggeration. And how are they exaggerated? Well, facts are often taken out of proportion, or experts can't resist commenting. And I find it interesting. I was on CNBC a few weeks ago and interviewed by a fellow called Ted David, and we got talking. He said, well, I'd like to have you on, in the future if you could come on. I said, yeah, I'd like to do that, but I'd like to come on when I choose rather than when you choose, because I'd like to come on when I have something to say that's important. And he said, I don't know, that's incredibly refreshing, because most people want to get on just to be on and see their face on and get publicity. So the point being that experts can't usually, they get called, they'll usually respond and come up with a commentary, even though they don't really have anything serious to say. Also, when you're looking at things, one of the ways in which they can be exaggerated, remember I was showing you that chart yesterday about the arithmetic scale. Well, most of these publications, if you look carefully at newspaper publications when they're coming out with economic news and all this kind of stuff, they'll often put the most recent, the chart on an arithmetic scale, which obviously exaggerates the higher prices and exaggerates things when they come down. And they'll often give you just the last tip of the information, and the thing may be coming down like that, but it may have been coming up from down here in the previous few years, but you don't see that in the chart, so things get distorted. So don't always believe everything you see and read. Number 2, you can get rich quickly. That's another myth. The vast majority of new market participants in the futures markets actually lose all their capital in the first year. That's a fact. I don't know the exact statistics, but I know it's a fact. Professional traders, you would think would make a lot of money, actually lose more trades than they make. They tend to make more on the winning trades and cut their losses on the losing trades. But they look at a ratio of something like 60%. They tend to look at a ratio where they would actually lose more times than they would win. The average annual return from the US stock market would have thought would be incredible, but it's something like less than 10% since 1926. So you can't get rich quickly. It's best to get rich slowly. Number 3, the more up-to-date the news, the better. It's the market's reaction to news which is more important rather than the speed of the news. I'll give you an example here. As Microsoft came out with their earnings a month or so ago, they announced good earnings, they announced a stock split, and the first time in a company's history they were going to pay a dividend. So you'd think that's pretty good news. But it's the market's reaction to news which is important, and the stock came down. This is an intraday chart, by the way. It's not a daily chart. But in the next few days, Microsoft stock came down fairly, I wouldn't say dramatically, but it certainly sold off pretty substantially. So the speed of the news was not important. It was really the market's reaction to the news which was much more important. Number 4, the experts are always right. I think we dealt with that one at great length earlier. Number 5, past performance is a guide to future profits. When we look at praising money managers or something, we often say, oh, okay, he's made X% in the last year, or that mutual fund's made X% in the last 5 years, I'll go with that. The problem is that money management styles come and go in a fashionable way. Here's an example. At the top we have the S&P Composite, and underneath we have Morgan Stanley's Emerging Markets Fund. Stock market's going up and the emerging markets are coming down. So based on past performance, which one are you going to take, the S&P Composite? Well, what happened was the S&P Composite came down and the Morgan Stanley Emerging Markets went up slightly. So past performance is not necessarily a guide to what's going to happen in the future. Here's another example here. We've got the S&P and the Wilshire Target Value Fund. During that period there, we have shown on the chart, the S&P went up and the value fund just went sideways. Pretty terrible investment. So you'd think based on that, you'd stick with the S&P in the index fund and stay away from the value fund. Well, here's the relative performance of the value fund. When that's coming down, it means the value fund is underperforming the S&P, and when it's going up, it means it's beating the S&P. It came down during that period, and during the remainder of the chart here up to the present time, the S&P comes down. The value fund goes up very slightly, but the relative performance was substantially better. So past performance is not necessarily a guide to the future. We tend to think that, but it's not really true, because money management styles come in and go out of favor, just like fashions do. Number 6 of the market myths, 7 market myths, the more you trade, the more you make. Well, the more you trade, the more subjective you become, and you also lose your perspective. And one of the things that we'll talk about in the next presentation about trading is you want to be as objective as possible. And there are 3 costs to trading that most people overlook. There's the cost that you pay your broker, that's commissions. Every time you get in out, you have to pay a commission. That's a cost of doing business. So the more you trade, the bigger your costs are against you. There's another cost, the cost that you have to pay to the floor in slippage. You might put a market order at a certain price thinking you could get it in a certain range, and the price may go against you. So there's a floor cost. So every time you go in, you've got that risk of the floor cost and the brokerage fee. And then there's the emotional cost, because the closer you get to the market, the more emotional you're going to be, and so the less objective you'll be, and that's a very important cost too. And finally, number 7, there is no Holy Grail. The Holy Grail is knowing that there is no Holy Grail. Thank you.
Okay.